Bringing in my next guest. It's going to be Matt Todd, Retail Director at S&P Global Ratings. Welcome back to the show, Matt.
Morning, Tom. Thanks for having me.
All right. So the consumer, before we get into that McDonald's discussion, I just kind of wanted to give a broad-based outlook here for the consumer here, Matt, because it seems like they're pretty resilient. Wage growth has been steady. Unemployment rate below 4.1%. So the consumer overall still feeling pretty good, right?
I think we're seeing two different consumers right now. So I think overall the consumer is fairly healthy. I think, and that's a result of the job market still showing strength. I think what we've seen, and this affects McDonald's, is the lower end consumer is hurting the most. They're the ones looking for value the most. And in the restaurant space, they might be eating at home more, so they might not even go into restaurants.
Yeah, I think that's going to be that bifurcation that we're seeing with the consumer, where the high end's still spending. We saw it out of some of the travel stocks. Those are doing well. The airlines have been doing well. So people are still out there traveling. Maybe some of that low-end consumer is still affecting. But if you take a look at McDonald's and their earnings, and this didn't even have anything with the E. coli outbreak within the earnings event. I'm sure the conference call is going to start here soon. We're going to get some more clarity on that. But this overall wasn't that great of a quarter, and we had rallied 30% before the E. coli outbreak from last earnings on the back of maybe traffic increasing.
Yeah, I think you mentioned it earlier. I think what we saw was weakness, a slight weakness in the revenue line item. I think international was the particular area of weakness. Places like China and Asia, I think, were particularly weak. One of the bright spots is actually the U.S. showing some same-store sales growth, and I think really what we're seeing there is the search for value. So kind of more of what we saw in Q3, but maybe a little bit more pronounced. But again, in the U.S. there was some bright spots, including growth in ticket size. So keeping operating margins fairly consistent. So we think it's kind of a mixed result. Certainly a little bit slightly softer on the revenue side.
Yeah, and if you look at that, the chain report of 1.5% decline in same-store sales on a global basis, up 0.3% here in the U.S., but licensed and unlicensed overseas markets getting hit. Now, if you attribute maybe the extension of this $5 meal deal in through December, that's been, I think, the reason behind the rally that we saw from last earnings is that, hey, we're going to extend this. It's really driving traffic, but then doesn't it also hint a little bit that the consumer, especially that low-end consumer, might be going there more just due to the fact that everything's so expensive out there?
Yeah, absolutely. The $5 meal deal seems to be very successful, and I think you see that in a couple places. So one, they extended it, so that's always a good sign. And that means it's not only driving volume, but the franchisees must, like it somewhat. It must not be hurting their profitability so much like discounting can, and that's probably because what we saw in the ticket size. So likely what's happening is folks are drawn to the value provided by the $5 meal, but then maybe picking up a coffee, picking up some other dessert, something that's a bit higher margin and something that's supporting the franchisees. So I think the $5 meal has been really successful in driving volume. I think the problem with discounting, the issue with discounting, is that you can't do it forever. It gets stale, or the consumer starts to expect it, so you can't ever get rid of it. So I would expect maybe McDonald's to maybe consider a new discount going into the new year, or maybe continue to expend the $5 meal as more of a permanent menu item. So we'll just have to see. But I think it has been successful so far in driving traffic, and you see that in the results in the U.S.
Yeah. So the warning sign for me here moving forward, Matt, is the fact that international growth is slowing even before the E. coli outbreak was announced. I'm sure that's not going to help at this point, but because they've got that such a big global footprint, is that kind of confirming that, hey, we're still doing well here in the U.S., but other parts of the world, which McDonald's relies on, is really struggling at this point, and maybe it's not going to get better anytime soon.
Yeah, I think that's true. I think the international market, like you said, they're a global company. More of their revenue comes from overseas than the U.S. So what and I think this is true across the economy. I think we're just seeing it show up in McDonald's very, very acutely, is that Europe is seeing weakness. I think the France market and UK were particularly weak and cited in the earnings release. And again, China is something you hear in the headlines constantly, consumer weakness there. And I think it's showing up. And also a lot of Chinese consumers are shifting. We're seeing this in many industries. They're shifting to more Chinese domestically produced type products and chains. We saw that in Starbucks releases as well.
Yeah, Starbucks, Luckin actually coming back to the U.S. They announced that earlier today. More pressure maybe on Starbucks moving forward. But if you look at this space as a whole, we've seen some nice gains in Chipotle so far this year, Cava on that side, even EAT, Brinker's doing really well. Yum Brands kind of consolidating here. What kind of outlook do you see for the whole industry at this point? Is it going to be, a pick and choose type of thing for investors to look at as far as the stocks go?
Yeah, I think that's a good point. And I think what you're seeing, why you're seeing that dichotomy is there's the quick service restaurants that are really value focused, and then there's the fast casual restaurants, which are a little bit more of a slight premium. And what we saw during this high inflationary period over the last couple of years is the prices between the QSRs and the Chipotles out there have compressed, so that there's not much of a difference between prices there. So the consumer who's really value focused right now is saying, oh, well, I can go get a burrito bowl for $12, $13, or I can get a Big Mac meal. What is that? Maybe $10 or $11 at full price potentially. And so, they might be choosing to go to a more of a fast casual restaurant.
Yep, I think this the battle is going to continue here at this point. I think the consumer is still making choices. McDonald's weaker today, down about 2.5%. All right, great discussion, Matt. Have a great day.
Thanks for your time.
All right, that's Matt Todd, Retail Director at S&P Global Ratings, breaking down McDonald's post-earnings.